time, I would like to turn the conference over to Chris Jonas. Please go ahead.
Hello, everyone. It's Chris Jonas. I'm the Director of Communications with the National Association for Business Economics. We're pleased to present today's webinar. Before we turn to the topic, I did want to mention a few upcoming NABE events that we have. Of course, in the wake of the COVID-19 outbreak, we are committed here to getting good information out on these developments. We encourage everyone to spread the word on these events, forward them onto your networks. As a reminder, all these webinars, these live webinars are free for the public as well as NABE members. We dropped a link on the webinar screen to the events page. We also have the NABE Digital Archive. That's where we post the recordings of our past webinars. We have just posted yesterday's recording on the Global Monetary Policy Update with Megan Green and Julia Coronado. Today's event will be recorded as well. The recording will be available to NABE members only later today on the NABE Digital Archive, and that is linked under the Events tab on NABE.com. And if you're interested in joining NABE, you can go to NABE.com/join for more information. So in terms of the upcoming events, we do have the China Economic Update in the wake of COVID-19 tomorrow at 11 a.m. We will have our Economic Forecasting Teleconference this Monday, March 23rd at 3 o'clock. Then we will have the U.S. fiscal policy responses to address labor market consequences of the coronavirus on Tuesday, March 24th. We will take a manufacturing angle on the impact of COVID-19 on Wednesday, March 25th. And then we have an Energy Roundtable webinar exploring the impact of COVID-19 on the global oil market scheduled for March 31st. Okay, I did also want to mention that we've relaunched econjobs.org, which is our jobs board. You can head over to econjobs, find your next job, or to post open jobs at your firm. Okay, on to today's event. Note that there will be no slides for today's event. It will be audio only. The webinar will include a question and answer period. However, if you have a question, you can go ahead and submit the question at any time during today's event. Simply type your question into the box on the left side of the window and then click on send. Okay, it's my pleasure now to introduce our moderator for today's event, Michael Chow with the National Federation of Independent Business. Michael, I'll turn it over to you.
Thanks, Chris, and thanks to everyone listening for joining today. I hope everybody is staying safe. So this will be a very interesting discussion because things are changing by the hour, if not by the minute, on coronavirus-related legislation, as well as the situation on the ground across the country. I'm pretty sure everybody on the panel had prepared remarks some time ago that they've had to since throw away out the window and type up new remarks due to changing circumstances, and then we threw those out as well, and now have before us whatever we've written down in chicken scratch as the latest and greatest. But it's always exciting to be on the cutting edge of things, and I'm very pleased to be joined on this call today by two great experts to help us make sense of the ever-shifting ground we find ourselves standing on. And on the call with me today are Joe Brusuelas, Chief Economist at RSM, and Thad Inge, Government Relations Manager at Paychex. Let me make a few brief remarks to provide some background on the coronavirus situation for small businesses before turning it over to Joe and Thad. Even before recent aggressive measures to mitigate the outbreak took place, small businesses, according to NFIB data, were already wary of the economic consequences that COVID-19 might have on their businesses. On March 13th, the NFIB Research Center released a survey on the impact the coronavirus outbreak was having on small businesses at that time. And at that time, we found that 23% of small businesses were already being negatively impacted by the outbreak, and another 43% anticipated being impacted if the outbreak spread to, or more broadly in their immediate area over the next 3 months. Of those owners who said they were negatively impacted, 39% said they were experiencing supply chain disruptions, and 42% reported seeing slower sales. At the time, the level of concern among small business owners about the coronavirus impacting their business varied greatly, with about 44% of small business owners saying they were somewhat or very concerned, about its potential impact on their business, another 37% saying they were slightly concerned, and 18% not concerned at all. Obviously, those numbers aren't going to reflect the current situation, since those numbers were taken before states began locking down in various ways to prompt social distancing by mandating closures of movie theaters, bars, gyms, and restaurants, except for drive-through and carry-out service, encouraging or ordering closures or reduced hours at non-essential businesses, curfews, and a shelter-in-place order has happened in the Bay Area and, as I understand, is on the table for New York City. Since that survey was taken, we've also witnessed more border closings, which now include the UK and Ireland, and as I hear, will soon also include Canada in a mutually agreed arrangement that curtails non-essential travel. NFIB hopes to have updated survey results that reflect small business sentiments on the impact COVID-19 is having on their businesses very soon. And I'm virtually positive that the numbers are going to be dramatically different, because I know firsthand that our member businesses have been calling and emailing us nonstop. They are extremely anxious about abrupt, slower sales and want to know what they can do to lessen the economic impact these orders issued for public health reasons are having on their businesses, and what assistance they can expect from federal, state, and local governments. A final note on this last point. For any small business owners tuning in, and even if you're not a small business owner but know a concerned small business owner, to answer these questions, NFIB has set up a coronavirus resource page on our website. It's accessible for free from our homepage, www.nfib.com, and it provides business owners, small business owners, with guidance on how to prepare and react to these rapid changes, along with the latest details on what's happening on Capitol Hill that will impact small businesses now in this moment of crisis and further down the road. With that, I'll turn it over to Joe first, and then Thad will speak to our listeners.
Okay, good afternoon. Thank you for joining us here at the NABE conference webinar on the coronavirus and small and medium-sized enterprise and business outlook. All right, so I'm not going to sugarcoat this. We've suffered a 5 standard deviation shock to the real economy over the past several weeks. The economic outlook for the first half of the year is somewhat grim. Depending on which industrial ecosystem you work in, if you're a subcontractor or you have a business that feeds into the big active multinational firms, today's a difficult day. The announcement by the big 3 automakers that they're going to shut down production will, of course, impact 150,000 workers and literally thousands of businesses across the U.S. economy. All right, my sense here is that in the first quarter of the year, we're going to have a pretty sizable contraction, somewhere between 2.5% and 3%, with downside risk. It's the second quarter that's going to be the most difficult period of adjustment. And of course, those of us who work with small and medium-sized enterprises always know that the burden of adjustment is always borne the greatest by those small and medium-sized enterprises out there across the economy. Like all economists, we're constantly revising down our forecasts, inflation forecast, and we're unfortunately revising up our unemployment forecast. I noticed today, after the Big 3 announcement, our fellow economist Mike Feroli of JP Morgan put out a forecast that said the economy would contract by 14% in the second quarter. So this is the sort of once-in-a-lifetime adjustment that we're all going to be facing. Thinking about the labor picture, tomorrow morning we'll get the weekly first-time jobless claims data. All right, so our model tells us that once that number moves above 242,300, that would imply the business cycle and the onset of recession. But given some of the rather grim jobless claims data we've observed around the country, I'm sure you've heard the American Intelligence Lodging Association indicates an 45% of all hotel jobs will be eliminated this year. The outsized increase of claims in Ohio, 50,000, 15,000 in New Jersey, and of course, the spate of system-wide crashes at the states as people who have been suddenly fired are seeking to replace that lost income or partially replace that lost income as soon as possible. My sense here is that we are heading towards an effective partial shutdown of the U.S. economy over the period of 4 to 6 weeks. And this will require a tremendous fiscal and monetary response to address the problems. We're going to talk a lot about that in a few minutes, so I'll let the sort of read most of that along. But I do want to assure you that both the Congress and the Federal Reserve are working on what would essentially be a corporate and small business lending facility guaranteed by a backstop from the Congress and guaranteed liquidity from the Fed. From what I can see, it looks like it's going to be larger than $1 trillion. Now, this was not done during the crisis, 2007, 2010, the financial crisis, but they are moving as fast as they can for the construction of such a facility, which requires 13.3 consent from the U.S. Treasury to let it go forward. Should that happen, it will be incumbent upon all of us working with our SME clients to make sure we match the clients who need bridge financing up with the facility to ensure the transition period for these companies, and so over the next few years they can go back towards solvency and growth. Now,
Joe, sorry to interrupt. Could you speak a little bit closer to your mic? We're just having a little bit of trouble hearing you.
Sure. Is that better?
Yes, thanks.
Okay, sure. All right, so we're going to see a fiscal stimulus, at least the first round here, in $1.2 trillion. It would appear that $500 billion that's going to be aimed at households with checks around $1,000 based on the news flow today, late April and mid-May disbursements. It's what that's looking like. But we don't have a good feel for the final composition of the bill. And my sense is that given the labor dynamics around the most outlier of risks, 1.2 trillion is not going to get it done. And we're going to be closer to 2 or even 3 trillion before we're through with this. Now, I'm going to stop there because we've gone over quite a big terrain where we've discussed growth, unemployment, and the policy response to this, both monetary and fiscal. And I want to turn it over to Thad for his portion of the introduction.
Thank you, Joe, and thanks, Michael, for having me. I'm not an economist, but I work in small business policy, formerly in the government, and now I'm with Paychex. We're a payroll and HR provider. We have about 675,000 small business customers. A lot of them are mom and pop shops that are impacted just like everybody with the current fallout from coronavirus. To Michael's point earlier, we did some surveys and research a couple of weeks ago. We were out in the field February 28th and 29th. That obviously feels like a lifetime ago in terms of the fallout. But some of the numbers that we got then, and even at the time I were like, these don't, look as bad as I would expected, but it was about 39% of small businesses were very or extremely concerned about the coronavirus. I think, as we were getting the results back, those numbers were probably shooting up and, or shooting up every day. I saw that the National Small Business Association did a poll March 11th through the 13th, and their numbers came back that 3 in 4 small business owners say they're very concerned about the economic impact of COVID-19, and nearly half of small businesses have already experienced reduced customer demand for their products and services. That was about 5 days ago, so I think just in those 5 days we've probably seen a lot of movement. Paychex is planning to do another survey probably next week, so we'll have some updated numbers around that. One of the things I do in my job is work closely with Congress and policymakers and track everything that's going on. So I thought I'd sort of overview at a high level, as Joe had alluded to, some of the things that Congress is doing and has already done. So we had the first supplemental bill on March 6th, which was only about 11 days ago when that passed, but also feels like a lifetime ago. And that was the $8.3 billion supplemental appropriations bill that they passed that mainly had a lot of healthcare components in there around the development of vaccines, therapeutics, diagnostics, that kind of thing. It also, and a lot of that went to state and local agencies. It also had some money for telehealth and Medicare spending. There was a small piece in there for small business loans that was run through the SBA, a current program at the SBA called the Economic Injury Disaster Loan Program. And those are direct loans. The way SBA works is 7A and loans that most people think of it as SBA loans are guaranteed through a bank. But for their disaster loans, they do direct loans. Normally people think of after a hurricane or some kind of disaster, but they also have these economic injury loans. Unfortunately, because this is not a FEMA declared disaster, each state governor has to apply for those individually. And so that's happening right now. I think there's 6 or 7 states that have gotten certified, and those are loans up to $2 million. And so, that's kind of the program that's out there right now. Obviously, it's just the tip of the iceberg. Congress is moving very fast. There needs to be way more, money injected into the system. And that kind of brought us to the second bill, Phase 2, which they're supposed to be voting on as we speak right now. There were a series of votes starting at 2 o'clock with some amendments and a final passage for what I call the Phase 2 bill is supposed to be sometime shortly. And it's about a roughly $100 billion package that one of the cornerstones of that is free testing for coronavirus. But it also had the unemployment compensation, increasing unemployment insurance, the paid sick leave and paid family and medical leave components, along with the tax credits, where folks could get 100% tax credit, or employers get 100% tax credit to make up for that money that was spent on paid leave. When they revised, they initially passed the first version out of the House early Saturday morning, and then they did a technical correction bill Monday afternoon, and that technical correction bill ended up with some pretty substantive changes to the paid leave component. I think there was a lot of pushback from some of the small business community that it was going to be hard for small businesses to carry that load, to wait to get the tax credit, even if they set it off by their payroll taxes, and that it would actually put some small businesses in a worse place. And so there's some new provisions in there kind of scaling back who qualifies for the paid leave, and also allows the Secretary of Labor to exempt employers with under 50 employees. And so how exactly that shakes out isn't clear, but it might be a situation where, the language is if the viability of the small business looks like it's in danger, the DOL Secretary can exempt them. And so before we're even done with this package, which, they started kind of working on in earnest at the end of last week, we're now on to Phase 3, as Joe was talking about, and currently they're talking for Phase 3 about a $1.2 trillion package, and it would include those direct checks to Americans, but also they're talking about $300 billion for a small business lending program for business interruption, and then looking at some distressed industries, both money for the airline industry and then there's a big bucket in there of $150 billion that they label for distressed industries. And this is just the proposal, I should say, that the White House sent over to Congress earlier today. Obviously, there are going to be lots of input. Mitch McConnell in the Senate is expected to kind of run the process around this bill, and but he's going to need bipartisan buy-in from Chuck Schumer to get it out of the Senate, and then they'll need Nancy Pelosi, obviously, to pass it in the House. They're moving, as they say, at warp speed. How exactly that shakes out, we'll see. I think folks would like to be able to do this weekend or by Monday, but it's obviously a big bill, so we'll see how that shakes out. But meanwhile, I think the panic in the small business community, from what we're seeing, continues to rise. Obviously, places are closed. This paid leave tax credit hasn't instilled a lot of confidence in people because it's unclear how it's going to work and how quickly folks will get this money. And I don't think that has sort of had the calming effect that was initially intended. And so it's going to be a lot of work over these next week or two, and probably, as Joe alluded to, this might not be the last stimulus bill. We might have a phase 4 and 5. That's one of the arguments that President Trump is making to make it really big. Let's do this once and for all and not have to keep coming back. But as this keeps getting worse, it might be where they have to keep coming back. But for now, Michael, I'll leave it at that.
Okay, thanks, Thad. So I have a number of questions here for both of you, but first I'd like to take a question from the audience, and it's directed towards Joe, and a member from our audience would like a better understanding of the state of play of the Fed Congressional lending facility that you mentioned earlier. What do you see in terms of how that's going to shake out in terms of timing and size, and how long will it take to implement?
Okay, so I just want to put this out there. Whether we're talking about action from the monetary authority or the fiscal authority, it's not going to be quick enough. All right, so once we all sort of understand that this is how this works, my sense is that the lawyers on all sides are still working through to ensure that what's going to be done is legal under the Federal Reserve and Dodd-Frank Acts, and that I'm very certain of this, that the White House and the Treasury want to move forward at the quickest pace possible to set the facility up and to get it running. So what did we get? The commercial paper and primary dealer facility yesterday on the 17th, and I think they were going to be fully functional up and running by the 20th. So I would expect that if something is agreed upon and if it's announced, you'll see it up and running 48 to 72 hours. It's important that it come in this is my own estimation, that it needs to be closer to $1.5 trillion with a fairly large $250 billion backstop from the Congress, because right now the gap between something being announced and something being done is not adding to the ability of the federal government to engage in stabilization policy, essentially. They need to stabilize financial markets, stabilize the economy, and buy some time to get in place the very large fiscal set of stimulus that are currently in train. Let me say this, that one of the profound mistakes during the financial crisis was not having a facility that specifically targeted the real economy, i.e. small and medium-sized enterprises. And the fact
hey, Joe,
Joe,
real quick, could you try to talk a little closer to your microphone again? Some of our listeners are happy. Okay, thanks.
Okay, sure. I think it's very encouraging what's happening, and that a facility is being set up. There's foresight within the policy community that if we had another one of these issues, the SME community was going to need to be targeted. It looks like it is, and I'm fairly confident that this is going to get done, and this will be extremely important over the next 2 to 3 months and in the aftermath of the public health emergency.
Okay, thank you. We're going to actually jump to another audience question right away. We're getting a lot. So this one is directed towards Thad, and one of our listeners would like a little more explanation about exactly how SBA disaster loans are distributed. Do individual states first have to apply to the SBA program, or are they available to all states? And then are states themselves responsible for identifying businesses that need the funds, and how are they distributed? I'm happy to make some comments, but the question is for you.
Okay, yep, and so each state, the way the Stafford Act works, even with the emergency that President Trump declared, that didn't trigger a nationwide program. And so each state governor still has to submit paperwork, and they basically just have to show that there are 5 businesses in the state that would qualify. And so my understanding, there were a number of states that did this for coronavirus that got approved January 31st. So California, Connecticut, I forget the whole list, but there was a list of states that have already been approved for over a month here. But my understanding is that almost every other state is going through that process right now. And so I think in the coming days, most states will be on that list. But the governor's office does have to, submit this paperwork showing that 5 businesses in the state would qualify. The loans are up to $2 million, and the business has to show about a 30% decline in revenue, and they would just go on the SBA website. It's EIDL loans, Economic Injury Disaster Loans, and there's a form that you fill out, and you have to document, revenues and that kind of thing. And you, if you can demonstrate that you've had that significant dip in revenues, then you could qualify for up to $2 million. Apparently, they announced yesterday that they're going to defer principal payments for the first year. So it would be interest-only payments for the first year. And again, they're direct SBA loans. I think you have to put up a personal guarantee for it. You can't apply until your state has been certified, but hopefully most states will be certified pretty quickly. One of the complaints I've heard, about them is you have to be in pretty bad shape to really be able to show that revenue loss to qualify for the loan. Then by the time you apply, and then, it might take a couple weeks to get the money, then you might be in even much worse shape. And so I don't think this is the answer, for our current crisis, but I think it is one tool that's out there right now that could be helpful to some small businesses.
Thanks, Thad. Okay, so we've talked a lot about the size of these various packages, and something I'm wondering is, I think we're all wondering is, are we going big enough, even with something around the order of $1.2 trillion or $1 trillion that's been floated by the White House? And I think the HR number was 6201 or 6012 from the House side. I'm curious as to your thoughts, and the packages are very different in how they're constructed, but in terms of overall dollar size, do you think we're going big enough?
Well, so when you're designing a fiscal package for what's undeniably going to be a recession, the first thing you want to attempt to identify is how large a hole has been blown in private sector balance sheets. Now, because this is such an unusual set of shocks to the economy, that's incredibly challenging in real time. So let's just do just a quick thought exercise on this. We got a $21 trillion nominal economy. That's what, roughly about $1.75 trillion, accounting for rounding errors. You would think you shut down this economy for roughly a month. Let's say, you're about 80 to 90% shut down, or even 100% just to make it easier. You're talking about $2.5 trillion in combined monetary and fiscal response. So there is a risk here that the first three tranches of fiscal aid just isn't going to be big enough. The Fed is setting up, they've already set up the commercial paper funding facility and the primary dealer credit facility, largely to deal with credit stress for the banks and the large companies. What I was alluding to earlier, the possible construction of $1 trillion corporate and small business lending facility, that certainly would help. But we're going to have to see how the crisis evolves. And remember, the most important thing here is monetary and fiscal policy can't solve the problems over there in the medical community. We can give them the funding they want. They should be given a full $15 billion, and we'll just have to see how this evolves. And if the social distance policy, which it looks to be the de facto policy that we're falling into, which is intentionally slow the economy, keep people away from each other in order to mitigate or slow the spread of the disease, works, that'll be only observed over time. And again, this is the most trickiest set of policy challenges I've seen in my lifetime.
And I would just add, I think we're in the unknown in terms of how long this lasts. I was looking at the small business interruption loan package that the White House proposed this morning, the $300 billion package, and they said these loans would be up to 6 weeks of payroll, and they would expect the employer to provide, 8 weeks of payroll with that. So we're talking 2 months from whenever folks get this loan. Hopefully, for everyone's sake, people will be back to work and businesses will be open again in 8 or 9 weeks. But if we find ourselves in a situation where we're not there and we are still shut down, I think that we're going to obviously need more money.
Okay, thanks, guys. So let's go to a question that I had and also an audience member had, and it deals with lending channels for small businesses. The question specifically is, since the banks are very strong, couldn't they serve as a good vehicle for bridge loans to small businesses while they're waiting for a government loan? And I know one or both of you expressed interest also in making some comments about alternative money distribution channels, whether it be through loans or grants. Do you have any thoughts on that?
Yeah, I'll just say, so I think most of the big dollar programs, they are looking at banking partners, like the $300 billion program that I just mentioned. That would, the lender would be U.S. financial institutions. They would provide 100% guarantee. And so if the small business, defaulted on the loan, the financial institution would then be made whole. And a lot of, government-backed loans work that way. There's obviously direct loans like the SBA program. And then I've heard talk sort of beyond financial institutions and beyond the current direct loans in sort of this age of technology. Are there other ways to get money in the hands of small businesses? People bring up things like Square. As a payroll provider, we've been approached in the last couple days because we have so much connection with small business owners. That's not something we're advocating for, but it's just an example that there might be different ways of getting that money out beyond just your traditional financial institutions. I think the challenge with that is we're moving very fast, and it's hard to stand up a new program. And so a lot of times Congress will kind of say, how have we done this in the past? How did we do this in 2008? And it's easy to just overfund an existing program and waive fees and whatever, give 100% guarantees, give low interest rates, whatever you have to do, as opposed to stand up new channels. But I think as agencies, once Congress passes this bill and agencies start to look, how do we get this money out? I think creative ways should be on the table, because it's not the same economy and we don't have the same technology that we had in 2008. And so you have to make sure you're able to, reach these businesses as quickly as possible and as efficiently as possible.
I think that was a fine answer, and let's just let that stand on my part.
Okay. So that leads me to another question that I had, and also an audience member has. So the question is really, are loans the best vehicle here, given the burden that it would place on businesses going forward, particularly since their shutdowns are no fault of their own. The government is talking about. So the White House proposal, calls for $500 billion allocated in two separate waves. I think the first tranche comes out, would be distributed, on April 6th. So that's $250 billion then, and then another $250 billion May 18th. So that goes directly to taxpayers. Straight up cash. Wouldn't a better vehicle be, again, grants towards small businesses who are shuttered through no fault of their own, rather than loans, which do place a burden on them going forward?
Well, I think grants are going to play a very important role in this, but we have to be realistic. Inside the Beltway, that volume or quantity of grants is just a political non-starter. I would think that looking at the very generous terms one can get from the SBA, if you need export-import help from Ex-Im Bank, or the array of agencies with offices that are set up to deal with this, to me, it's really just within the realm of the acceptable, given how large the overall level of the government fiscal stimulus is going to need to be. If there's a lending facility, hypothetically, let's say the terms were 2.5% per year, quarterly payments fixed over 5 years. That would seem to me to be a pretty prudent way of organizing a massive quantity of bridge loans to stabilize the economy that's populated by small and medium-sized enterprises up and down Main Street. I think I understand where this question is coming from. I appreciate where this question is coming from. But given the fiscal space of the United States, I think this is about the best that we could expect.
Yeah, I think it is hard on small businesses. A lot of them would have debt on top of debt, and so a lot of these business owners might already have a mortgage on their building, or might already have loans that they're paying off, and then when they get back in business, they would have an additional loan, and so that's always a point of contention, and I think a legitimate policy debate is, does it make sense to have these businesses pay back this money? In the past, I would agree that it's been very hard to argue for either loan forgiveness or for grants. Policymakers tend to be more comfortable with loans. There are things like this paid leave bill that's passing this afternoon, where I think by saying you get 100% tax credit for what you pay out, in a sense, it's not a grant, but in a sense, it's trying to make you whole for this money you pay out for paid leave. But I think it's going to be a debate that's not going to go away, because even probably this might crop up years from now, because let's say all these small businesses get these loans now, and maybe they're deferred for 6 months or a year, and those that are able to survive, once they have to start paying on that principal, we're probably going to be dealing with that question, of loan forgiveness, and it's a tough one.
Thanks. So we have a question about supply chains, turning the conversation in a little bit of a different direction, and the challenges in getting product for small firms throughout this crisis, however long it lasts, and whether that product be from China domestically or actually from anywhere in the world, not just China. Thad, I know in earlier conversation you had some thoughts on that, so maybe you could share your thoughts there, and if Joe has anything to add, he's welcome to follow up.
Yeah, and maybe it's just because there's so much that's happened, but it almost seemed like a bigger issue a week or two ago when you, with what's going on first with the tariffs with China, and then the fact that a lot of small businesses are supplied by China in Asia in general, that we were hearing small businesses say, I can't get, my supply chain's broken down because the factory in China was shut down, or it's held up 6 months, that kind of thing. And so I think they're sort of on an international scale, were concerns with small businesses that if I can't get my product, I can't sell it, and maybe to a lesser extent some of that was happening domestically. And then in the healthcare supplies arena, that was obviously a big discussion in terms of most of our healthcare supplies are manufactured in places like India and China. We don't have a lot of domestic production here, and that caused challenges, obviously from a public health perspective, and also from a business perspective. And so, I think that is probably still a major issue for some companies, and then others have kind of moved on to the next phase about even having their doors open. But it's definitely a challenge for a lot of small businesses.
Yeah, we started working with our clients mid-late January on this issue. We were counseling them to focus on three things: alternative supply chains, alternative transportation, because we recognized early on that there wasn't going to be sufficient number of containers to ship tech and agriculture over to Asia, or finished goods over to Europe, and then finally liquidity, which we've addressed significantly here. What we've tried to do is to match up alternative suppliers here in North America to substitute for the lost goods used at earlier stages of production, or intermediate goods just not showing up from China, Asia, and South Korea. To a certain extent, it's been successful, albeit, North American suppliers are just going to be more expensive, right? And that results in thinner margins just to keep production up. When you think about, say, housing, roughly you build a new house, 30% of all components that goes into that comes from China. So that's a very significant undertaking, which we expect will begin to show up in the data in terms of slower residential investment, slower pace of completions. Now, based on our clients in China, we expect them to be back up to full production by mid-June, which should coincide quite nicely with the resumption of some level of economic activity here in the United States. In my sense, it shortens the duration from trough to recovery here in the U.S. economy. And it's something you want to watch closely as an economist. I think we're all counting days with respect to the Chinese case, the Korean case, and then the Italian case, which all three are very different.
Okay, thanks. I want to take the conversation in a little bit of a different direction now to address another audience member's question, simply because we're bringing up some international aspects. You just mentioned China and South Korea. So the question is, do you have any thoughts on, from a global perspective, to add, and are other countries taking timely action, or if our actions are timely enough, are they preparing enough like the U.S. is? I hope I phrased that appropriately for the audience member who asked.
Okay, this is Joe. So we see this as a global public health emergency in a series of waves. It's Asia first. It's getting more intense in Europe, and then it will get more intense here in North America later this month and next month. I see countries moving very forcefully to deal either with containment or mitigation, especially in Europe. The borders are now closed. You've got shelter in place in France. It's really going to happen in other spots. And then it will roll here. Where I'm somewhat concerned with is in the southern hemisphere, with the exception of Australia, where they really need strongly to address this. There appears to be somewhat of a delayed effort. Sense is, as we move into the fall here, you could see an increase in cases in Africa and across Latin America. I know that Brazil has to move very, very quickly to deal with this because of the density of the population, where the economy is clustered, and the large number of people, and I think we generously call it non-modern medical infrastructure. This is a emergency or crisis that's just simply going to be with us through next year on a global basis. And in our estimation, we are already in a global recession.
Yeah, I don't have anything to add to that.
Okay, thanks. Then we'll go on straight to the next audience question, building upon earlier comments that you gentlemen made on supply chains. So the question is, does the situation now, sorry, trying to get back to the question. Okay, the questions are coming in so fast that I can't find it. A lot of questions, but I think I can sum it up this way. Is this coronavirus shock and the impact that it's having on the supply chain disruptions right now going to impact the supply chain landscape permanently in terms of, geographical shifts in supply chain, moving things back domestically, et cetera? Again, I apologize to the audience member because I can't find the question because we got so many coming in. But I think I've phrased that appropriately in a very general sense. So I'll let you guys take that.
Okay, and I'll just go quickly and then let Joe talk about it. But anecdotally, from what I've heard, I think there will be some shifts. I've heard of folks moving production from China to Cambodia, so sort of internal Asian moves. And then I've heard a lot of discussion around the need for stronger domestic manufacturing, especially in the healthcare space, but beyond that as well. And so I think there could be more of a willingness for policymakers to invest in that going forward, and more of a focus on diversifying supply chains. So folks do have alternatives if this kind of thing came up in the future. So how widespread those are, it's hard to say, for me to say right now, but I think there will be an impact.
Okay, so we've got clients all over the world. We're constantly talking to them on the ground. I have to tell you, there's two ways to sort of look at this. The first is there going to be widespread repatriation? There's not. For the past 25 years, firms have spent trillions of dollars investing in these supply chains all across Asia, not just China. The idea that they're going to come home, it does not comport well with reality. And when we talk to them, they smile and say, yeah, we understand the politics of it, but we're not going to go back. Second, for the past 5 to 6 years, China has planned to move a lot of the low-value production offshore as they move up the value chain. So you are naturally going to see migration of some portions of the supply chain to places like Vietnam, Cambodia, India, Malaysia, Indonesia. That's not going to stop. Perhaps the trade war did intensify some of the traffic. I know at one point Vietnam just didn't have any more workers to absorb any more moves of low-value supply chains into their country, so it tended to go elsewhere. Okay, my sense is that perhaps the one area that may be the exception could be in pharmaceuticals. We'll have to see how that plays out. But I think the best way you could look at this is there'll likely be further diversification away from China, but not necessarily back to the United States. Globalization, I know, after this is not going to be popular. The populist voices, the nationalist voices, the recidivists are all going to blame this in part on globalization now. I could probably make a pretty good case that's not true, but I don't think this is the time or the place to do that. But again, my sense is anybody who's out there expecting grand repatriation of their supply chains and these jobs back to the United States, that's just not going to happen.
Great, thank you. Okay, we're going to turn to a crystal ball question now from an audience member. And I wish you luck. So the question deals with job loss predictions. Audience member says they just heard that the restaurant industry could lose somewhere between 5 to 7 million jobs from the current crisis. Do you think that's a reasonable estimate range? And more broadly, looking at the overall economy, are we looking at maybe 20 to 30 million jobs lost temporarily or permanently? I don't know.
Okay, so I think one way to look at this is to think about the different data sets that we have at our disposal to make these sort of estimations. Okay, my sense is that over the next 4 to 6 weeks, we're going to see a significant increase in initial jobless claims. I mentioned earlier that the number our model says is commensurate with the end of the cycle is a move from, say, 215,000 more or less to where it's been for a while to about 242,000. Then we're going to be looking at the cyclical peak during the last downturn, which was 665,000 in March 2009, and then the all-time high of 695,000 posted in October 1982. My sense is we're going to surpass those numbers here probably pretty quickly. Right now, as we review, we're starting to put together some of the impulse shocks that are subjecting the economy to. When I look at employment, I would suggest we're probably in the near term, say by mid to late summer, observing unemployment rate somewhere in the range of 6.5 to 7%. The level at which it peaks out is contingent upon the type of recovery and the recoveries we're going to get in different industries. Private equity, manufacturing, and housing should see rather sharp, even somewhat V-shaped economies. Leisure, hospitality, travel, tourism, retail, there's going to be significant demand destruction and destruction of capacity to produce. So that's going to be a very different discussion in the aftermath of this. By definition, the sort of sharp but short shock that's going to cause the economy to contract by a significant amount in the second quarter almost guarantees that we're not going to get an overall V-shaped recovery. I think it'll look more like the Nike logo swoosh, and it'll be an elongated and frustrating recovery depending on which industrial ecosystem you're in. Thank you.
As the non-economist on the call, I'll leave it with Joe's answer.
Okay, thank you. And let's move to an advice question from an audience member. What should small businesses do now to ensure that they maximize growth during the eventual recovery period when they're able to do business again?
I think, what we're telling our customers are sort of as they're amidst, this crisis is to plan, evaluate their response plans if this outbreak hits their business specifically, make sure they're as prepared as possible, revisit their business continuity plans, and their sort of options if they do have to pause or stop operations, which I know a lot of businesses already have. Obviously, from the HR perspective, there are lots of challenges. And so sort of evaluating their HR policies, what are their obligations, what are their resources, things like this, paid leave law that's just now passing, and, how to sort of maximize people's ability to work at home, and making sure that they're continuously communicating with their employees and their customers. And so they're, if things do stop, they want to be able to build up that goodwill and go back to their customers once things reemerge. They're able to get back to full speed. So those are some things sort of in the midst of the crisis. I think when folks come out of this, it's going to just similar to 2008. It's going to require folks being more efficient, more cognizant of debt and sort of what they take on, and just sort of doubling all efforts to maximize their revenues.
I think that you want to do a couple things. One is use as an excuse to just stress test your balance sheet. Two, continuously reach out to employees and clients. Utilize all the technology you can to get yourself, your brand, your people in front of your clients. Third, and finally, it's a good place to stop. We're about to engage in a great giant social experiment where every task that can be done remotely will be done. Use this as a learning experience to increase efficiencies, scale, and depth of your operation. Because anytime you have an external crisis like this, whether it's a recession, a depression, or a war, the status quo ante never holds. Things change, and they change permanently. And so we'll have to change with it. And I know that's not popular among small and medium-sized enterprises, but given the gravity of the crisis in front of us, I think it's incumbent upon us to dynamically evolve in as quickly way as possible and adapt as quickly as possible to new reality. Thank you.
Thank you, gentlemen. I have the time as 4 o'clock right now, so I think that will unfortunately have to be our last question. Chris Jonas, do you want to take the microphone here?
Yeah, thanks, Michael, and thanks, Thad and Joe. And I want to thank you all for participating in today's NABE webinar, which is copyright 2020 by the National Association for Business Economics with all rights reserved. This does conclude the event. Thank you all again. Stay safe, and may now disconnect.
Thank you. Thanks so much.